our asset classes don't behave in the same way, and they change at different rates. And so we've seen better risk-adjusted returns in the industrial space in the back half of the year as cap rates have widened out.
I'm joined today by Czarnecki, President and CEO of Broadstone Net Lease. So Chris, can you start by talking about how Broadstone's portfolio has been growing and performing in the current economic climate?
This year we've had a very strong portfolio growth. At the moment we have guidance out there for more than $900 million of acquisitions, and we have that both under control or closed at this point. In terms of actual portfolio performance for the year, it's been very strong as well. 100% rent collections through the end of the third quarter is one that we're very proud of. And really, when we think about how diversified we are, that's certainly very important in the uncertain environment that we're in. But we also think about the underlying tenancy that helps support the portfolio. It's in a number of defensive industries, and we've had a lot of strong concentration in healthcare, in food processing that we've continued to grow this year as well. And those are very defensive spaces that will position us well as we come upon any uncertainty that we might face in the future with the economic situation.
And what benefits has Broadstone's diversified strategy provided in 2022? And what opportunities do you expect in 2023, given this differential strategy?
Absolutely. One of the things that's most important to us is maintaining a very diversified portfolio, and that starts across a number of different property types. And how that's played out in 2022 has been an ability to pivot as cap rates have changed over the last year. And so when we started the year, we had a very heavy Q1 focus on restaurant and retail assets. And then in Q2, Q3, and into Q4, we've done a lot more in the industrial space. And to us, our asset classes don't behave in the same way, and they change at different rates. And so we've seen better risk-adjusted returns in the industrial space in the back half of the year as cap rates have widened out. And that's been a net positive for us to be able to be flexible and pivot into industrial when other asset types have not been as responsive to cap rate changes and changes in cost of capital. Looking forward, I do think that cap rates will continue to expand into 2023. I think they have to, based upon what we're seeing from a rate environment and from an economic environment. And so as I think about the opportunity for Broadstone going forward, it's more weighted towards having some of those other categories in our portfolio, maybe play a little bit of catch up, more healthcare, more restaurant, more retail, as those cap rates normalize over the period to come. And we think that can be a nice offsetting balance to the work we've done in industrial in 2022.
And what steps has Broadstone taken to shore up its balance sheet, given the likely uncertainty ahead?
Absolutely. Balance sheet strength is something that's of a critical focus for us, and we were very active over the summer in a number of key focus areas. One, we were active on our ATM program and raised about $20 million in Q3. We also did a forward equity offering that we haven't yet settled, but generated or will generate about $270 million of net equity proceeds. And then finally, also put in $500 million of new term notes, 5 and 7 year duration, and we were able to swap those at about a 2.6% interest rate over the summer. So very strong capital markets activity to give us a lot of flexibility going into next year. As of the end of Q3, we had about $1.1 billion of liquidity, so we feel like we're really well positioned. Our net leverage position, inclusive of the forward equity, was about a 4.8 times net debt to EBITDA. And so we feel like that's a really good spot to be in going forward, and all those proactive steps we took over the summer should position us well going into 2023.